Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Good afternoon, 7 investors, and welcome to the Monday edition of 7 Investing Now. Apologies for being a little bit dark. I had to switch locations very late in the game. My name, of course, is Daniel Brooks Klein. I'm being joined today by Anirban Mahanti, and we're going to talk about the giant breaking news that happened overnight. That Square going to buy. Thank you for staying up 2 in the morning over there in Sydney, Australia.
Hey, Dan, you're breaking out, but great fun to be up because of the exciting news.
Yeah, we are having some technical difficulties here. I don't know if it's on my end or on your end, but why don't we set the table a little bit here, and why don't you explain what happened overnight with Square agreeing to pay $29 billion in an all-stock deal for Afterpay?
Yeah, so so Afterpay is the buy now, pay later, basically juggernaut, or the company that invented buy now, pay later as a category, right? And if you think about it, buy now, pay later appears very simple. It's basically installment payments, right? And it has been around for many years. In Australia, we call it, there's a thing called lay-by, which basically means that, I'm going to pick up this thing during Christmas time, and you book the item and you basically pay for it, between now and Christmas, and then you pick up the item during Christmas time. This is sort of a lay-by sort of idea. After we basically took that idea and turned it around on its head and said, well,
here's what we're going to do. We're having technical difficulties here. Why don't we close this in 15 minutes? Any of you who are watching, we're going to rejoin here in 15 minutes. I'm going to try to get a better internet connection. I don't know if it's my end or your end, but hopefully my connection is fixed at home. So Sam, we will rejoin and just maybe put up a we'll be right back screen or something like that and keep this connection live. I will try to get to a better internet location. We'll see y'all in a minute.
Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Welcome once again to the Monday edition of 7 Investing Now. My name, of course, is Daniel Brooks Klein. I'm being joined today by Anirban Mahanti. If you tuned in at noon, you know we had some technical difficulties. We hope those are behind us. We had a bit of an internet outage in my area. My backup site is a Starbucks. That did not work, but that is not the big story today. The big story today is we are going to talk about Square buying Afterpay. This was a big deal. Normally on a Sunday, we're a little bit sleepy. We're putting together some notes for the week. This hit us out of nowhere. Matt Cochran shared, hey, wait a minute. Square reported its earnings a few days early. Why did they do that? They did that because they announced they were purchasing Afterpay, a buy now, pay later company, for $29 billion in stock. This is an all-stock deal. Anirban Mahanti, it is 2:20 in the morning in Sydney, Australia, but you're under lockdown, so there's not much else to do. Why don't you tell us a little bit about Afterpay? This is, of course, an Australian company.
Yeah, so Afterpay has been, at the vanguard of leading the tech charge, the fintech charge in Australia. It's really popular down here. So like buy now, pay later as an idea is very simple, right? You want to buy something today, you don't have to pay for it, you pay for it in installments. And the idea has been around for a long, long time. Here in Australia, we have something called lay-by, which is basically you want to buy something for Christmas. You buy, you basically put some money down and then you periodically pay for it and you pick the stuff up at Christmas time. Afterpay basically took that idea and turned it on its head and said, well, you can have the item now and the retailer gets its money now. The consumer then pays Afterpay in installments over time. Of course, then how does Afterpay make money? Well, Afterpay actually makes money from the retailer. The retailer basically pays a cut to Afterpay. And the reason they pay a cut is the basic idea is that, well, if people want to buy something and have it now, they're willing to, spend that money. And therefore, the retailer is essentially getting additional transactions. The retailer is willing to take a cut on that. So that's the basic idea. It has been humongously popular here in Australia, and it's actually gone to the UK. It's actually popular in New Zealand as well, and then has gone to sort of the US, mostly the eastern seaboard, or mostly actually California and a few other places that the thing has taken off in the US. But that's basically the idea. It's the antithesis of credit cards.
Yeah, so you're not paying a premium. And as we've talked about, I used to run a toy store, so we did layaway. We would take the item, put it in a closet, and you would make payments, and then you would pick it up in theory at Christmas. In reality, a lot of people never finished, and it left a bad taste in their mouth. They stopped being customers. So this, in theory, is really, really good for retailers. But let me ask the Afterpay question before we get into the valuation here. What's the differentiator here? Because I know today I was on Amazon, and I bought about $60 worth of eye drops. And it asked me, do you want to split this payment up over 12 months? Of course I don't, because it's $60 worth of eye drops. It's not a big ticket item. We'll talk more about that later. But what's the advantage of it being Afterpay? This was not a name that was on the tip of my tongue. As a US consumer, Affirm was really the one that came to mind. So why is Afterpay a $29 billion company?
Yeah, so a couple of things here that's worth keeping in mind. So Afterpay is almost like a verb here in Australia, right? And I don't, again, I can't speak to how well it is. Now entrenched in the US, although their gross merchandise volume from the US is now much larger, I believe, than what it is from Australia. So they're basically taking hold. One way to think about this is, the best way to look at it is the gross merchandise volume, right? So how much transactions in total dollar volume is going through the Afterpay channel, right? Or Afterpay payment model. That is for 2021 was about $21 billion. That is up from $5 billion in 2019. So that's massive growth, right? There is uptake for this. And I think I was a bear for this because, again, I had the same question that you said, why would I have to Afterpay it? I've got credit cards. I can just put it on the credit card and pay off the credit card. What I realized over time is maybe you and I are not the demography that it is targeting. You and I are probably the type of people who are okay to have a credit card. There are people who don't want to have a credit card. There are people who want to use Afterpay for essentially, I would say, budgeting or cash flow management, right? And one of the cool things about Afterpay is it is really about small money, like small money transactions. It's not about buying a $10,000 item and then sort of spreading that out. Now, there are buy now, pay later models for that as well, but that's not what Afterpay actually specializes in. Afterpay, so I have an Afterpay account, just to give you an example. My Afterpay credit limit is $1,200. And actually, it is $1,200 because I've spent some money on it. It used to be $200. So when I first applied for my Afterpay account, I got $200 and I could spend up to $200. So I spent a little bit. Then over time, because I paid it back, it increased, and now it's like $1,200, and it's basically linked to my Apple Pay. So for me, so I'm the other type of consumer who probably doesn't need Afterpay, but I use it because I can, and it's very simple to use. You can pay online. It's linked to my Apple Pay, and it gets, they take out the 4 payments that needs to be taken out over the for fortnight via my Apple Pay. So I still get my points, which is interesting way of doing things. The other side is, I think, like any of these systems, any of these ecosystems, right? They depend on a couple of different things. One is, do you have enough consumers using it? Do you have enough merchants using it? So Afterpay today has about 16 million, I think, customers. 16 million users or clients, you and I, type people like you and I. That's up from massively up over the last 4 years, and it's got about 100,000 merchants using, or that allow Afterpay to be used. So that's a pretty big base of users that are using Afterpay. So it's a little bit of a ecosystem in that sense.
So let me jump in here. First, let me set the table. You're watching 7 Investing Now. I am Dan Klein. He is Anirban Mahanti. We would love your questions and comments. We are coming to you a little bit late. We opened with some technical difficulties, but we see a ton of you watching. So we would love your questions about this. So this deal, now we talked about the brand name a little bit, and I want to get into that a little bit more later, but is the opportunity here that Square has this massive network of relatively small and mid-sized merchants that can't offer this type of service. If I go to my local farmer's market and I want to buy, I don't know, $80 worth of gluten-free products, which is something I've done, or I want to go to the meat market and buy, a roast and stuff that can get fairly expensive, in theory, that payment is going to happen on Square. So I could essentially finance my, fresh fish purchase or my candles or whatever it is at the farmer's market over X amount of months using Afterpay. Is that the market Square's going after here?
That's a great point. So yes, so Afterpay, so let's set the table here. Exactly, you said Square is really popular, for example, here in Australia too. Exactly, when I go to the farmer's market, I see everyone with those Square terminals getting their payments, right? But there's no Afterpay on it, right? So Square's got merchants of different types. Square's got the SMBs mostly, and Square is trying to go upstream in terms of its merchants, right? It wants to have enterprise merchants. Afterpay actually has enterprise merchants, right? So Afterpay would have deals with chains, and most of the big retail chains would be with Afterpay. So in a way, it's complementary. They've got SMBs. Afterpay has got enterprise. If you merge the two together, you essentially are going up and down the stack in terms of your customer merchant base. So that is definitely one of the plays here. And the other play would be the consumer side, right? So Afterpay has got the Afterpay app. Square's got the Cash app. Merge the two together, and you have essentially expanded the ecosystem. Right, and I think it might be worthwhile for us to think about that. If you think about the total reach that you can achieve by just cross-pollination, you're just expanding the market opportunity here. So I think that's in a way, after Square is paying for the brand name and is doing a bit of customer acquisition, is doing a bit of merchant acquisition, and you can then sort of do a bit of cross-selling. It's not a traditional cross-sell in that sense, but it is cross-sell if you think about the way they think about how the apps are going to evolve.
So this is a massively growing space, but let's ask the question that we probably got asked the most in some of the social media run up to this. Why would you spend $29 billion to buy something that you could make for, I don't know if the number's tens of millions or hundreds of millions, but it's not going to cost you $29 billion. What was the reasoning behind buying this already growing company, but certainly not a company that necessarily screams $29 billion valuation?
Right. So we can come to the valuation, but maybe if I don't know if Sam can pull up the chart we had for the merchants at this point. If you can pull up the chart for the merchants, if you look at the complementarity here, right? So Afterpay's got only 100,000. Square's got millions, but look at the difference in the channel, right? The channel difference is Afterpay is mostly online, and Square is mostly offline, or at least has a big chunk offline. And one has got enterprise customers, one has got SMBs and mid-market. One is primarily retail, another is primarily mix of different things. Another there's a complementarity of geographies, right? Sure, Square can build this, but how much time is it going to take to build this is the number one question. Number two question is, you are acquiring a brand here, right? I mean, anybody can make it, but are you going to get the brand? Are people going to associate, the buy now, pay later, the leading brand with Square, or is it going to be with Afterpay? So having the Afterpay brand is important. So you're paying for the brand. That's number two. You're paying for the already existing ecosystem. That's number three. Is the valuation right? We can talk about that. But I think there are good reasons why I think this can't be built, at least by Square immediately or in the near term. The other important thing I think to bear in mind is the space is heating up, right? So you said there's a firm, there are at least 5 different buy now pay later companies here in Australia itself.
Anirban, let me give you some numbers here. And when I say give you, you put these into the document. More than a third of American consumers used a buy now, pay later service by July, according to a study this summer. 20.8% of all buy now, pay later users tried it for the first time in 2020. So 2020 is last year. That's not that long ago. And pay later apps downloads have surged 155% to 8.43 million, shooting up to 1.4 million in September, up from 650,000 downloads in the same month period last year. Is this just a case of this is the moment, and if you're not in it with a ready-to-go product, it's going to move on without you?
Yeah, so that's a good one, right? So here's what, typically consumer tech or consumer technology gets invented in the US and then gets exported elsewhere. Seldom does it happen that it's invented somewhere else and then it gets exported outside, and into US, right? So in case imported into the US. So I think buy now, pay later sort of as a category has just started taking off in the US. It's just got the prominence because there's all these, there's Klarna, there's, Affirm, there's, Afterpay, all competing. We're hearing that Apple is going to launch it, PayPal has launched its buy now, pay later, right? So there is that buy now, pay later is well established here in Australia. So I think this is a question of, a model that has worked really well here, which with a huge, and here's the thing, people would think that, the consumer base for this is, those people who don't have enough money. It's actually not, it's quite affluent people are also using it because they just don't want to have the credit cards. So I think sometimes what happens is there's just a change in model in terms of the simplicity of getting it. There's no credit checks. It's a very simple application that credit naturally increases. And that sort of trend is flowing over there. And I think the market has just heated up and people have realized that a lot of people actually appreciate this approach for payments. So I think that's what's really happening. Again, hard to say is it the moment right now, but it appears like, this is sort of, the wind is blowing in that direction, that people are looking for buy now, pay later type of solutions.
So Square,
that's what I would think.
Square has some knowledge about your finances because in the US, buy now, pay later has, at least with the big players, largely not been an application. Amazon did not ask me to apply. They just offer it. My American Express Platinum, which is normally a pay your whole balance off card, will offer me to split payments for no fees on certain items. And it's not necessarily the biggest ticket purchases I've made. I've tested it out just to see how it works. Not that I necessarily needed it to do that payment. And it's like sometimes like a $200 purchase. It'll just be like, do you want to split this up over 4 months, 6 months, 12 months? Is it possible that because Square has knowledge of your bill paying, knowledge of some of your cash flow, that they'll be able to extend this benefit the way Amazon has without asking for any sort of an application? And that application, it's worth noting, does not involve a credit check, I am pretty sure.
Yes. So, like, if you think about buy now pay later from Square's perspective, right? So if you've got the Cash App, they have knowledge about what you're doing with that app, right? So they could therefore use that app to facilitate a buy now pay later type of model. I think that makes complete sense. I think the underlying sort of, checking for the credit, underlying credit evaluation model, underlying fraud detection model, underlying willingness to pay over time model, those things I think can be carried over from what Afterpay has been doing here locally and globally onto Square. But again, I think the critical thing is how many people actually have that buy now pay later app, right? I mean, it's one thing that you're going to pay at Amazon, and Amazon is offering you the opportunity to buy now pay later it, versus you want to buy something from some retailer, random retailer online. Are they actually going to offer it, right? And that's not going to be the Amazon buy now pay later. That's likely to be a big buy now pay later player who's going to be able to offer that, because that's what the retailer is going to be signing up with, right? So merchant has to sign up with the payment modality, right? Because ultimately the payment is made by the buy now pay later player to the merchant. So I think for the big merchants, it's okay. Those like the Amazons, they can take the credit, I guess the credit risk, so to speak. But are the others going to take the credit risk? They're not going to take the credit risk, right? So I think that would be the play, in my view.
We're going to take Robert's question in a minute, but I want to ask the question, is this an incredibly cash-intensive business for Square to be taking on? Is Afterpay, if they're essentially paying the merchants, they have to have an awful lot of cash on hand, right?
That's a great question. So this is a common misconception, right? So this is the beauty of the model. So think about it. Let's say you've got $1,000, right? So $1,000 as available in your pocket kitty, the buy now pay later kitty. You could offer the $1,000. That $1,000 is actually being lent out effectively only for say 6 weeks, right? Because you make an initial upfront payment and then you pay the remaining over every 2 weeks. So between 6 to 8 weeks, you've paid off the amount. So let's say Afterpay is giving $200 to some consumer to pay effectively to buy, say, jeans, right, or shoes. That $200 is recouped in 6 weeks, 6 to 8 weeks, right? Effectively, you can turn around the $200. 52 divided by 6, effectively 8 times, right? So if you could take the $200 and then make it, you can lend it out effectively 8 times. So you can cycle the money, which is how it really works, right? Because then Afterpay goes out and borrows money, say at like a couple of percent interest, right? So 2%, and then it's probably extracting 4.5% to 5% from the merchant, but it's actually getting the 5% 6 times, right? If it is able to actually get that many transactions, which is the other thing really, right? What Afterpay talks about, which is how many times does a consumer transact with Afterpay? That's really important, because that number is, for somebody who has been in the Afterpay ecosystem for a client for less than a year is about 4 times. But if somebody has been in the Afterpay ecosystem for 4 years, they transact using Afterpay 30 times, right? So that's Afterpay's game. Afterpay's game is to make consumers use it more often. That basically means more efficient use of the cash that they've got. And I think this is the other thing where the acquisition comes into play. The cost of funding for Square is got to be lower than the cost of funding for Afterpay, So actually the cost of funding goes down. And if you can keep the take rate, which is essentially the amount of money that you're getting from the retailer as a cut, roughly the same, you're actually expanding your margin. So I think that's the other reason to be part of a behemoth, is that your cost of capital actually goes down.
And is it fair to say what the retailer is paying is relatively in line with what they're paying credit cards anyway? So this is kind of just another financial angle as a retailer. Like, I know when I ran a store, I didn't want someone to pay with American Express because they took a much bigger cut than, and then you knew the nuances. In some cases, like taking a debit card was better than taking a credit card. So is this just one where they just have to be in the competitive mix in terms of the piece they take of it?
No, so this is another great question. So no, they take more, right? So 4.5% to 5%, if that's the take rate, that's substantially more than what you would pay for, the acquiring bank for, transacting a Visa or MasterCard through, right? So it's definitely more than that. The reason merchants use it is that they have seen that having Afterpay actually lifts their average, the total number of transactions that are going through their store, right? So in other words, they are getting those transactions that they would otherwise not have. So it's worthwhile for them, right? And in the retail world, this is what I say about the retail world, right? I mean, everything is on discount all the time. So people, instead of giving 30% discount, if you give 25% discount and then you give a little bit to Afterpay, it's okay. So it's neither here nor there. But I think yes, the transaction cut is higher, and it has to be, because again, Afterpay is borrowing money effectively to lend out, to consumers, indirect lending out to consumers, right?
We're going to talk about the mechanics of this deal and how Anirban, whether he likes it, whether he would have preferred they take on debt. Before we do that, I want to take a comment from Robert G. Court. I hope I'm getting your name right. And he says that it's a good point. Mm-hmm. Apple could have built headphones, streaming music app, but instead bought Beats to get to market. Yeah, but they paid what, a couple billion, $4 billion maybe for Beats, and really they were buying a brand name. I don't actually think Beats is a superior product, though I am using Beats as we speak. So, and I think you might be too. So, is this that?
I'm using Apple.
Did Apple base its own off of what it bought? Perhaps it did. But that being said, was this just a get to market strategy?
Yeah, that's a good. I love that comment from Robert. So I think Apple is unique in that Apple hates to pay too much. And Apple bought Beats for not just the headphones, but actually bought it for music. Apple Music basically came from Beats. The Beats at the radio station was the genesis behind Apple Music. So this is really a strategy thing. And some companies really like to buy fully evolved products. So Afterpay as a category is a fully evolved category. It's a category of itself. The category is underpenetrated. The category has massive runway. There's a lot of competition definitely coming in. Anything that has got a massive runway is going to see competition. And therefore, one quick way to get to market is to buy the leader, right? And then basically push that instead of trying to be another competition with all, so everybody else is there. Apple is going to be there. There's PayPal, there's Affirm, there's Sezzle, there's Ziff. There's so many of them, right? Instead of trying to compete in a crowded market, you just acquire the leader and then basically push with that. That's one strategy, which is different from Apple's strategy. Again, I don't have a view as to which one is better. I think, of course, if you spend less, it's better. But not every company is Apple, is what I like to say. So.
Thank you for the comment, Robert. Doris and Renee Cronell, good morning. Daniel Delgado, thanks for tuning in. We hope you're all still sitting here. We would love more questions and comments about what this means for the market. Before we talk about the actual mechanics of the deal, I want to talk a little bit about, it's the 2nd of the month. That means that yesterday, our new 7 investing recommendations went live. We have an amazing array of picks. What's interesting about our team is we're all different. We have some conservative picks, we have some daring picks, we have some companies I've never heard of. I will say that I am going to buy somewhere between 2 and 4 of the picks in addition to mine, which is pretty typical. So if you'd like to know what our picks look like, what they are, and get our huge write-ups. My write-up came in at about 3,500 words this month, and you don't have to read the whole thing. You could just read the top line takeaway or the sections you care about. We also all went over 30 minutes in our video presentations. Again, you don't have to watch the whole thing. You can skip around. You can just go to the end to see what questions we ask each other. However you want to use 7 Investing, that is all right with us. So if you'd like to become a member, go to 7investing.com/subscribe. Once you get there, all you have to do is give us either $49 a month or $399 a year. That is a tremendous deal. That is more than 2 months free. Exactly how much more, I cannot tell you, but it is more. And for that, you don't just get our picks. You get access to our members-only call. You get access to a ton of members-only content. You get Max's home address. You don't get that. But you get all sorts of access to us and ability to interact, and it's a ton of fun. We have a family vibe. I've said it many times here. We all enjoy each other's company, and I think that extends to our interactions with members and other things we get to do. But Anirban, let's get back to talking about the story at hand today, the only story we're going to talk about today, and that is Square paying $29 billion to buy Afterpay. They're doing this in an all-stock transaction. They have not talked a lot about what the leadership's going to look like, how separate the companies are going to be. Why did they do this for stock and not borrow some of the money when cash is really cheap right now?
Yeah, that's a good one. So, I mean, we could argue that Afterpay, Square's stock is expensive, right? So, I mean, I call it a bit of quantitative easing. If you've got, if you've got a high-valued currency, you can print some, and it causes a little bit of dilution, but not a whole lot of dilution, right? So Square couldn't have paid this much cash because they didn't have that cash. I think the deal says that they could pay up to 1% of the transaction in cash if Square chooses to do so. It's an old stock deal, which is that they're getting about 0.375, I believe, is the correct number.
That is
effectively,
correct.
I think Afterpay shareholders are going to effectively own, I think, 15% of the company or something, somewhere around that, once the deal is done. And why not take debt? That's an interesting question. I think that's a philosophical question to some extent, right? So debt is cheap. You can take debt and you wouldn't dilute shareholders. I think the problem, though, is, like in my view, is I think debt is great for companies that are hugely cash generative. So someone like Apple can take on debt, and it makes sense for them to take on debt because they generate gazillion dollars of free cash flow, like somewhere in the $80 to $90 billion of free cash flow. If you generate that much amount of cash per year, then you take on debt and you can pay that debt off very easily. Debt typically comes with debt covenants, right? So they'll come with some earnings covenants and things like that. And Square and Afterpay are really operating in the finance sector where all you need is a little bit of something and then everything can go haywire, right? So that's a very easy way. I've seen so many companies get into trouble because they had debt that they couldn't basically service their covenants. The covenants, only if you could rewrite those covenants, and that you don't want to be in that nasty position of having to rewrite those covenants and things like that because you hit some sort of, consumer spending can be very, very cyclical, right? So I think for that reason, I think it's smart to do an all stock deal where you're using essentially an expensive stock. Or when I say expensive, I mean, on a traditional measure basis, right? You do an EV over gross profit, or you do an EV over sales. It's Square is expensive. And then I'm saying that as a shareholder, I've been a shareholder of Square for a long time, and I continue holding the shares. So I think it's a smart way to go about making these sort of transactions. In terms of leadership, the Afterpay leaders are coming, the co-founders, they're coming on board as they're going to be running Afterpay inside Square. The question is, how long are they going to be running it is to be seen. And I think Jack Dorsey is an interesting personality, right? So he comes across as a strategic CEO, vision-based CEO who lets other people do all the operations.
Let me just jump in. I assume everyone watching would know this, but Jack Dorsey is the CEO of Square. He's also the CEO of Twitter. So he's in a very unique position where adding some really strong lieutenants running a big part of the business is not the worst thing. Just want to set the table for anyone who maybe doesn't come to this sort of as wonky in the weeds as we are.
Yeah, so that's right. So I think having strong management folks to potentially even take over as CEO, and he could move over to being like an executive chairman or something like that. is a potential. So I think it may be that there is a future for Afterpay's management folks, the key people in over time. So again, what I think is interesting is, one way to look at this, the deal is it was an expensive deal. On the other way to look at this, the premium on the trading price is about only 20-25%, right? It's not a huge premium on the last traded price. So, and definitely is actually well below the highs the company hit somewhere around, I think, a few months back. The stock was trading at about 160 Australian. The deal, I think, is around 125. But of course, the deal varies with the Square price. The Square was up 10%. So, again, the market seems to be happy with what's going on.
Yeah, it's important to stress that debt comes with risk. And this is a business where if you told me Afterpay is up 300% at Christmas or 30% during the Christmas season, or 3,000%, I'm not sure I would know what the answer is. So they need to maintain the ability to raise cash if they need cash to fund operations. And when I say fund operations, I mean fund that 6-week float, because they could have that big of a holiday season. If you already have debt, that can become tricky. You don't want to have to rein in credit or not offer these deals at the busiest time of year where you should be acquiring customers because you don't have the cash. And Anirban, we're going to talk about the historical financials. I know you have a graphic here, but before we do that, I want to just acknowledge a couple of people. Scott Eisenberg says, love the show. Listen every Monday when I'm at work. You can also listen on Wednesday and Friday, but you don't have to listen live. This show is also at 7investing.com/live stream. It's on our YouTube channel. You can find it on any of our Twitters. It is very easy to find this show. Ravi Shah commenting on our picks, which I talked about a little bit ago. Awesome picks. I already owned 3 of the picks, so felt awesome. Yeah, that to me, I love when we're sort of providing the backstop for someone who owns something. They go, oh my God, Anirban bought that? Like, that's great. That to me is something I'm very, very proud of, especially when it happens within the team. When I pick something and someone says, oh, I was thinking about buying that, or oh, I own that, I really like that feeling. And Yao Seng Sikta, and I am probably pronouncing that incredibly wrong. Again, a little bit of a vision issue at this distance. Hey, everyone. Nice to see all of you here. Yeah, it is nice to see so many of you here with us when obviously this started a little bit rough this morning with some technical difficulties. Daniel Delgado, we'll get to your comments in a minute. But Anirban, let's talk about the financials here. Obviously, this deal is based on potential. This is a space that if you told me buy now, pay later was 10 times bigger a year from now, I think I'd probably believe you. I'm throwing out a lot of made up numbers here. But this area does seem, because I have to admit, I was tempted to be like, why should I pay $60 for eye drops all at once? Why not spread it out over? Of course, I'm going to need more eye drops before that would come due. So that would not be the type of thing you should be financing. But Anirban, you have a graphic here.
Yes. So, we don't need to really talk about this. We talked about the consumer side. I mean, this is the consumer side of the business where Afterpay has 16 million consumers and 70 million on the Square. And I think there's a lot of complementarity here. Sam, if you could give us the third graphic that we had, which is the financials. Excellent. Thank you. So if you look at the gross profit numbers, of course, Square is significantly bigger than Afterpay. The thing to note, though, is the growth rate. The growth rate for Afterpay is higher, on a year-over-year basis or on a CAGR basis, so a compound annual growth rate basis. So I think this does result in an acceleration for the combined Squares growth rate. I think where this is going to hurt, though, is in the near term, at least, I think in terms of operating profits. So Afterpay is not as profitable on an operating basis as Square, so the margins are lower. I think you can expect therefore the combined entity will have a lower margin. Of course, you could say that, well, if for $506 million of gross profit, you're paying about $30 billion or $29 billion, that's a huge, that's almost like a 60x. So exactly as Dan said, this is basically for the potential. If that 500 million is to become 5 billion and then 10 billion, then there may be 50 billion over the due course of time. This deal will be worth it. If it is not, well, then this would probably be an asset write down.
Let me ask a question that you asked in the document. What happens to the take rate over time? You pointed out it's about 4.5%. 4.5% is not out of line with what American Express takes from smaller merchants. I'm sure your giant players of the world get a better deal with American Express did than I did with the 2-location toy store chain. But that being said, do you see this number coming down, or do you see on certain areas maybe it could even go up if it's riskier purchases?
Yeah, so that's a very interesting thing, right? I mean, so I don't know this is very hard to speculate what's going to happen. It really depends on the competitive dynamics, right? So think about PayPal, for example, right? So PayPal is, rolling out the solutions. If PayPal is going to charge 0 for rolling out buy now, pay later, basically it is taking it out of its existing cut that it has, then the merchant has to basically do the computation and say, okay, I pay 3% to PayPal, but then the buy now pay later doesn't cost anything. Versus if I pay to Afterpay, well, I have to pay 4.5%. What do I do? I have a feeling as more players get in, the take rate is going to go down. That's what should happen. But again, I think that also would be indicative of the market expanding. More players getting in basically is indicative that the market is expanding. There's a larger market opportunity, and capitalism brings competition. So you'd compensate for that by higher gross merchandise volume flowing through. So maybe it's okay.
We're going to talk about competition, and we're going to take Daniel Delgado's question in a second. But I wanted to ask first. So one of the things I've always talked about with mortgages or lending in general, if my mortgage company has seen me pay my mortgage for 5 years, they once got a full picture of my financial history, why, when it's time for me to get a new mortgage, can they not just use that past history rather than doing the full background check? Is it possible that these buy now, pay later firms look at someone like you or I, who, I'm going to assume we both have very good credit. I know I do. I have a bunch of credit cards that I pay off every month and I'm using largely for points. What stops a company like Afterpay to go, okay, why don't we finance a car for you and give you an even better rate? Or why don't we allow you to make a big purchase? I'm not saying a house, but maybe a $1,200 computer or something like that, where there's a lot of ability to expand here. And I'm not a credit risk based on my history of payments, which they would in theory have access to.
Yeah, so Dan, that's great. This is one of the things that they talk about in sort of the merged entities goals, right? So buy now, pay later for Afterpay is small transactions. Taking the transaction volume up is one of the things that they are talking about, which is sort of in line with what you're saying, right? If you're not a credit risk and you can spend more and you will pay more, you will pay it off over time. Why not? This seems to be definitely an avenue over time for them to do. And yeah, again, and then for those maybe bigger transactions, the cut is smaller, but that's okay. Maybe they take a smaller cut on those transactions, but they have just larger volume to take the cut off. So I think that's a definite possibility over time.
Yeah, I look at this whole industry and things that are supposedly disrupting the mortgage or the loan industry, they're really not. Rocket Mortgage is just a slightly different process. The underwriting is all the same. And then you look at something like insurance, where you're seeing some truly disruptive companies. Lemonade pops to mind, which is using algorithms and not medical exams. And I see some room for these companies. But let me share one comment that's in the doc that was shared by Andy Wolfarth on Twitter. He says, "Is a firm in trouble?" And this speaks to what Daniel Delgado said. If you want to bring that up, Sam. Daniel Delgado says, "Is there enough space out there with all these companies like Square, PayPal, Apple Pay, SoFi, Visa, Citigroup, Stripe, and many more? Which are the best companies?" A lot of them are the best companies. I think there's a lot of investable companies in this space. I think that's a whole other show, maybe a podcast where we get Matt Cochran to join us as well. But I actually think historically banks have been very investable. And these are kind of just extensions of banks, and many of them are just run really well, and the numbers are fairly obvious. So I'm not sure the success of Afterpay necessarily dooms a firm. In fact, do you think it's likely that, obviously the Square market is an advantage because Square can say, well, we offer Afterpay, we're not offering a firm. But just like places offer Visa, MasterCard, American Express, in some cases even Discover Card, maybe Diners Club, who knows? You could see a firm Afterpay and maybe even a third player, right? There's room for more at the party.
I think so. I think so. So it could be a duopoly or a triopoly or quadpoly, something like that could evolve. I don't think this is a winners take all market. And if it's like a 10 trillion or whatever it is, e-commerce spend, for example, globally, it doesn't have to be a winners take all for some of these players to win. And I think the other point to realize is each company comes at it from a different perspective, right? So Apple Pay with installment payments, their objective is different from Square, right? Their objective is to keep people happy because you want to do installment payments and therefore we offer it, right? It's not necessarily about making money there. They'll make money somewhere else. So, and that could be, you could think of that, somebody's product becoming your feature, somebody else's, feature. That is a risk. But again, I think it's big enough that I don't think it puts a firm at any danger as such. And maybe a firm has got a relationship with Shopify, I believe, right? So I mean, there's nothing that's, for example, stopped Shopify from saying, well, these guys have, Square has bought this one, I'm going to buy that one, and there could be more consolidation again. I don't know, but that's another possibility.
I think it's very likely you see either consolidation or an exclusive deal there, because this is absolutely a shot at Shopify. That said, I am very bullish on both of these companies. I want to close out with two questions here. The first is buy now, pay later something you age out of? Because I've used it, but I've used it as like an afterthought. Because in general, when I buy online, if it's on Amazon, I use my Amazon credit card. I auto pay that full bill every month. Unless it was a month where, like, for some reason, like I bought like a $900 massage chair on Amazon. Maybe I paid that off over 2 or 3 months instead, using one of these services. But is this something you age out of, or will it just become like part of your life and part of your budgeting, where maybe you use it more heavily like the holiday season and the summer, and then you pay those debts off during the slower parts of the year, which I guess would be the spring and the fall?
That's a hard one for me to answer. Like, I feel that there are, according to Afterpay, there is a demographic which really is anti-credit card, and the risk that, one of the things with credit card, I think that people forget, is if you forget to make a payment, you are going to be slugged with huge interest, right? You're not slugged with huge interest in Afterpay. So I think, just an innocent forgetting the payment is a problem. And some people have been soured by that. So I don't think this is a fad. And like you, I use Afterpay when I can, right? I don't have to do a checkout, and I just use Apple Pay and it instantly pays for it. The address is there. But I would use I use Afterpay whenever I can, because again, why not? But I'm probably not the target demographics, as I've just said.
But we both are to a point at the higher end. So it's not Afterpay, it's not a firm. But when I've had some unexpected large expenses, and I'll give you 2 examples. We redid the floor at our other house. That was roughly $11,000 worth of expense, and about $6,000 of that was material. And I paid that off over 6-8 months on a 0% interest card from the company I bought it. When I got my laser eye surgery, because I could pay for that using my wife's healthcare account, which didn't have the amount in it, I set that up to pay off over time, because it's essentially free money that comes from her employer. So why not do it? So I do think there are things where, like, if all of a sudden you came home today and your air conditioning was shot, could you spend $10,000, $12,000 on air conditioning or a new roof or whatever it is? Of course you could, but do you want to? Is it fun to do that? I think that's where the higher demographic comes in. But obviously, you need 100 small customers to be able to get the cash to finance a roof or something at a relatively low margin. But let me throw this out, Anirban. You can comment on that, and then I will give you the final question, unless any of you have any others you'd like us to ask. So if you have something to say it now in the chat.
Well, look, I think I agree with you, right? So that going upstream in terms of dollar volume is definitely a game that's going to be played. It's going to make it more attractive to a wider range of customers. I think that's definitely on the cards. It's not what they do currently, but yeah, I think it's not off the cards. We'll take the last question.
No, it's so theoretically, this could be like a threat to credit cards in a certain sense, where, again, and I've talked about this a lot, the more a company knows about you, the less of a credit risk you are. And I'm not entirely sure that a credit score is always a good example of that. In history, some people are going to do anything they can to pay off debt, even if it means going without. Others are not going to do that because there's not a lot of negatives to pushing credit card debt down the road unless you're actually thinking of how much interest you're paying. One last comment from Doug Henningman, a name I've never seen here before, so I wanted to get it in. Interesting. Square is up 11% today, or a $12 billion increase in market cap. That actually speaks to my last question. My last question here, Anirban, is this is a company I believe you are a shareholder of. Do you like the deal now that you've had roughly 24 hours? I know you use the metric system, so it might be 10 or 100 hours over there, but roughly 24 hours to digest this. There is no metric time. That is a joke fueled from Battlestar Galactica. But that being said, do you like this deal as a shareholder?
Look, okay, so I like the potential of the deal. I don't quite like the price. As Matt Cochran would say, the price is high. So I think that a lot of execution has to go really well for the price to be justified, right? And I would have liked a lower price personally as a Square shareholder. I think every Square shareholder probably is going to say the same thing, that could have paid less. But maybe this is a battle that has to be fought, because otherwise it's going to lose the battle to PayPal and others. So maybe this is a battle that Square had to fight, and this is the way to fight it. But yeah, the price is high. Again, there's no opinions in my mind. I think that's true.
For those of you new to the program, you are watching 7 Investing Now. We do this every Monday, Wednesday, and Friday, normally at noon Eastern. We had a bit of a technical difficulty. Anirban, I got one of those automated robocalls saying that the internet would be down for 90 seconds. I got that 40 minutes after the internet went down for 90 seconds. If I had known that,
Fantastic.
I never would have left. That being said, we asked you how you felt about the deal. By you, I mean the 7 Investing Twitter audience. Sam Bailey, who's been a trooper today, if you could share that, I would love to close out the show with our finisher. Do you think Square did the right thing in agreeing to buy Afterpay for $29 billion? About 38% of you said yes, 21.5% said no, 40.8% said too soon to tell. Anirban, I would have said too soon to tell yesterday. I actually kind of have been talked into this deal. I actually like the potential here. I think, look, it could hit a brick wall, but I don't think so. I think we want to spread out our purchases. And look, will some customers get into trouble with this? Absolutely. But some customers get into trouble with credit cards. And would I rather you get into trouble with a financed pair of pants than a $4,000 vacation put on your Visa? I actually think this deal might make sense without having really dug into the numbers. Obviously, $29 billion is a very, very big number, but stock, I don't want to say it's play money because obviously it is dilutive, but it actually kind of isn't real money. Again, I know I'm being dismissive there, but I like what they did. I like the potential. I don't expect this to be a write-off. I actually expect this to be fairly transformative for Square. Your thoughts?
Yeah, I think I agree with you. I think, with the caveat, there's an expensive deal. There's a lot riding on execution, but I think this can be a meaningful, rocket ship sort of idea for Square. Basically takes it to the next level. So yeah, I mean, I like the deal. I like Afterpay as a company. I think they have been extremely innovative. Really, thought leaders, and I think that has value, right? If you bring on people who are thought leaders who can think out of the box, I think that is meaningful. So you're acquiring talent as well.
So Anirban, I don't want to put you on the spot here, but is this the largest Australian mergers and acquisition deal ever done? It has to be. It has to be right up there, right?
Yeah. So I think this is the largest deal ever, and it's definitely the largest tech deal ever. So I mean, this is something, again. This is a bittersweet thing because this company is going to be off the ASX, right? And it's been a huge, if you're investing in this company during the COVID downturn, you'd probably be up 12x or something like that in 18 months. So a lot of people, a lot of retail money has been this. A lot of people are going to be rich because of the deal. I hope that a lot of people actually decide to take and keep the Square shares. and partake in the long term. But again, I think this is good. This is good for the Australian tech community. A success in that sense.
There are going to be a lot of other shoes to drop in this space. Anirban Mahanti, I know it is roughly 3 a.m. there at this time, so we very much appreciate you. I don't know if it's getting up or staying up. I'm not sure at this point if you go to bed after this, or if it's just like when I travel to England and it's early in the morning, and if I can stay up till like 9 o'clock at night, I won't have jet lag. So you can let us know on Twitter how you're going to handle the rest of your day. This has been very exciting. We appreciate so many of you playing along. We appreciate you putting up with, obviously, our 20-minute delay and technical difficulties at the beginning. I'm going to be back on Wednesday. Not sure what we're going to do on that show. We had some really great things planned for today. We're going to have Simon Erickson and Matt Cochran on Friday. If you'd like to get in touch with us, it is info@7investing.com. Let us questions about our service, questions about some of the mechanics, how this works. If you'd like to interact with us, that is @7investing on Twitter. We are fun to interact with. Let's close out with a couple of comments here. Why not? We've gone on off script. Daniel Delgado, a friend of the program, says, that was a great show. So much great info that was delivered. Thank you, Daniel and Anirban. This was Anirban's show. There are times where like I'm bringing something to the table. In this case, I was facilitating, and I was overjoyed to watch Anirban and Simon and Matt. And if he wasn't traveling, I'm sure Steve would have gotten into it. There was a lot of interplay. There is a lot of knowledge on this team. And Doug says, and again, I'm not even reading these, so I appreciate, there's a couple of comments here. Dan, you were great and entertaining. I'll just say at the other place and here at 7 Investing. Like the real world retail experience. Yeah, I love the fact that sometimes I can bring something to the table. The fact that I bought commodities, that I ran a store, I do think it's a little bit of a different tack. The fact that Anirban spent the past 6 years in research and has real world experience, and Max has science experience, and Dana's running a business, and Simon ran services and has done so many things. And I don't want to slight anybody because our team is just unbelievable. And so are all of you. We thank you. We really do. This means a lot when you stick around after. I don't want to show you what my heart rate did according to my Amazon Halo while we were sorting this out. But if I wasn't otherwise healthy, I would have been concerned. With that being said, for Anirban Mahanti, for Sam Bailey, for the entire 7 Investing team, we thank you, and we will see you on Wednesday.